picture this scenario, right? It's late February 2026.
Okay, setting the scene.
Yeah, exactly. So you are standing on the pristine terrace of this, like, massive 500 square meter ultra-modern villa. You're on the Palm Jumeirah in Dubai.
Sounds pretty incredible, honestly.
It is.
Yep.
I mean, you just wired 5 million euros to buy this place because, well, everyone pitched it to you as the ultimate impenetrable fortress for your wealth.
Right, the perfect safe haven.
Exactly. You've got zero income tax, ironclad financial privacy, and a government that's literally dedicated to protecting your capital. So you're looking out over the water, holding a drink, feeling completely untouchable.
But then reality hits.
Yeah. You look up and you literally see a flash in the evening sky. Debris from an intercepted military drone is falling out of the atmosphere, and it's landing right near the Burj Al Arab.
And see, that specific visual, it fundamentally shatters the whole illusion of global wealth management. I mean, completely.
It really does. It's like the bubble just pops instantly.
Yeah, because for decades, the global elite have operated on this basic assumption that capital simply finds a safe harbor, drops an anchor, and appreciates in total peace.
Like it's disconnected from the real world.
Exactly. But the physical reality of a geopolitical conflict intersecting with a manufactured financial haven, that forces an immediate violent recalculation.
Right, because the safety was basically just on paper.
Well, yeah. When military debris lands in a jurisdiction specifically engineered to be the world's premier financial sanctuary, capital doesn't just get nervous. It actively panics and flees.
And that's what we are looking at today. We're witnessing the complete redrawing of the global wealth map, like in real time.
It's happening right now as we speak.
Welcome to the deep dive, by the way. Today, our mission is mapping the exact migration of the global elite's capital. The supposedly permanent safe havens of the early 2020s are being entirely redefined.
And we brought some heavy-hitting data to prove it.
We really did. We're digging into the comprehensive UBS Global Wealth Report 2025 to understand the sheer scale of the money that's currently in motion.
Which is a staggering amount, by the way.
Oh, absolutely. Plus, we're tearing apart the specific regulatory updates from the Dubai International Financial Center. We need to see exactly how they successfully built that wealth oasis in the first place.
Right, you have to understand how they lured the money before you can understand why it's leaving.
Exactly. And then we are going to cross-reference real estate market data from Savills, along with this fascinatingly timed property analysis from MP Dunn. That one was just updated in March 2026.
Yeah, the timing on that report is incredible.
It really tracks exactly where this spooked capital is running to right now.
And, you know, the value of layering these specific sources is that we're connecting these massive macroeconomic tectonic shifts with hyper-local real estate mechanics.
Bringing the huge numbers down to the actual living room.
Exactly. Like the UBS data provides the volume and the origin of the capital, but the MP Don report gives us the literal physical destinations where that capital is hiding after the shockwaves of early 2026.
So we are tracking a macro-level panic down to the exact square meterage of a house in Southern Europe. I love that.
It's the only way to really understand the market right now.
Well, let's start with the sheer volume of capital in play. Because, I mean, you can't understand the migration without understanding the size of the flock.
No, absolutely not. You need the baseline.
Looking at the UBS Wealth Report, the very first data point is just that the world got measurably wealthier. Global wealth actually rose by 4.6% in 2024.
Which was a really significant rebound from the dip we saw in 2022.
Right. But when you disaggregate that number, when you break it down, the growth is wildly uneven. Like the Americas drove a massive 10.2% jump.
That's a huge surge for just one region.
It really is. Meanwhile, EMEA, Europe, the Middle East, and Africa essentially flatlined. They only saw a 0.44% increase.
Barely moving the needle.
Exactly. The Asia-Pacific region saw a modest 2.85% bump. But then Eastern Europe emerged as this massive outlier, growing over 12%.
Yeah, that Eastern European figure surprised a lot of analysts, but the really wild stat is the concentration at the top.
Oh, you mean the country breakdown?
Yeah.
Yeah, the report concludes that just two countries, the United States and mainland China, now hold 54% of all personal wealth across the 56 markets analyzed.
More than half the wealth in just two countries? It's crazy. But we have to look closely at the underlying engine of that 10.2% growth in the Americas.
Because it's not exactly what it looks like on the surface, right?
No, not at all. It reveals a huge structural vulnerability. According to the UBS data, total global financial wealth leaped by 6.2% in US dollar terms, but non-financial wealth only expanded by 1.7%.
Wait, so break that down for me. What's the difference there?
Sure, so non-financial wealth means tangible assets, things like property, infrastructure, physical businesses. That part barely grew.
Ah, I see. So the explosion of wealth in the Americas isn't driven by, like, building new factories or anything real.
Exactly. It is overwhelmingly driven by upbeat U.S. equity markets. Specifically, it's the concentration of capital in mega-cap technology stocks, combined with the extreme strength of the U.S. dollar.
Okay, I actually want to push back on that dollar strength aspect for a second.
Okay.
Because the report authors themselves emphasize that currency movements drastically distort these international comparisons.
Oh, they do. Massively.
Right. Like, if the U.S. dollar is exceptionally strong against the euro, the yen, and the pound, does that 10.2% growth in the Americas represent actual economic output? Or is it merely an accounting illusion on a spreadsheet?
Well, honestly, it is mostly an illusion. Measuring wealth strictly in U.S. dollars creates a highly deceptive mirror.
Because if everyone else's wealth, when converted back into dollars, suddenly looks smaller, we might just be completely misinterpreting the health of the global economy.
Exactly. To understand actual prosperity, you must measure wealth in local currencies and then rigorously adjust for domestic inflation.
And what happened when UBS did that?
The picture darkened considerably. Measured in U.S. dollars, over half of the 56 markets analyzed saw average wealth per adult decline. But even when measured in local currency and adjusted for inflation, 13 countries still saw a reduction in real average wealth.
Because inflation is basically just a silent, corrosive tax on your purchasing power.
You hit the nail on the head. If a portfolio grows by 5%, but local inflation runs at 7%, the investor has experienced a real-term contraction of wealth. It doesn't matter what the headline figures claim.
Wow. Which brings us to perhaps the most critical distinction in the entire UBS report. And this is something you listener really need to grasp: the divergence between average wealth and median wealth.
Yes, it is mathematically impossible to understand who holds global wealth without separating these two metrics.
Right, because if a nation records a 10% rise in total personal wealth, it does not mean the average person is 10% richer.
Usually it just means the top 0.1% captured a massive monopoly on new equity growth. That completely skews the mathematical average, while the wages of the remaining 99.9% basically stagnated.
So how do economists usually explain this? I know there's that famous analogy.
Yeah, the traditional way economists explain this is by putting a billionaire in a local coffee shop full of average earners.
Right, suddenly everyone in the room is a statistical billionaire on paper, on average.
Exactly. But the median customer, the person right in the middle, is still just trying to scrape together enough cash to afford a $5 latte.
That's a great visual. But I feel like a modern corporate structure might be an even better analogy for what's happening right now.
Oh, absolutely. Imagine a multinational company where the CEO receives a $50 million equity grant because the stock surged.
Okay, yeah.
But the 10,000 rank-and-file employees, they just receive a standard 3% cost of living raise.
Right, so if you average the wealth creation across that whole company, it looks like a highly prosperous year for the average employee.
Exactly. But the median employee, the person standing exactly in the middle of the payroll ranking, only saw a marginal bump that barely covered the rising cost of groceries.
And the UBS data proves this divergence is happening globally, right? Sometimes even in completely inverse directions.
Yeah, the numbers are wild. Let's look at Mexico as a prime example.
Oh, Mexico's fascinating. In 2024, the average wealth per adult in Mexico actually fell by over 18%.
Right, so a headline reader would just assume the Mexican economy was in total freefall.
Exactly. But then you look at the median wealth, the exact middle point of the population. That actually rose by over 12.5%. And when adjusted for local currency metrics, it spiked by up to 16%.
The top went way down and the middle went way up. The mechanics behind that Mexican divergence are so interesting.
What exactly was driving that?
Well, you have emerging market currency depreciation and fluctuating global asset prices. That severely hit the dollar-denominated portfolios of Mexico's ultra-high net worth individuals.
So the billionaires lost a lot of paper wealth, dragging the average down.
Right. But simultaneously, you have a massive surge in nearshoring. Manufacturing moving from Asia to Mexico.
Oh, of course. That drives up domestic wage growth.
Exactly. That, combined with robust cross-border remittance flows, directly bolstered the balance sheet of the median Mexican worker.
So the top tier lost capital, but the middle tier actively gained ground.
Yeah, it's a profound shift.
And then you look at the United States, where both metrics actually grew, but at vastly different velocities.
Right. The U.S. numbers are almost hard to believe.
Seriously. Average wealth in the U.S. grew by roughly 9%, but median wealth, that exploded by over 45%. I literally had to read that figure twice when we were prepping for this.
A 45% increase in median wealth is huge. It indicates that the middle and upper middle brackets are accumulating capital at a rate that proportionally outpaces the extreme upper brackets.
The wealth is no longer solely pooling at the top 1%. It was swelling the ranks of the tiers sitting just below the apex.
And this expansion of the upper middle tier is the absolute core driver of the global real estate shifts we're analyzing today.
Yes, this brings us to a specific demographic the UBS report classifies as the IMILI.
The everyday millionaire.
Right, the IMILI. These are individuals holding assets valued between 1 million and 5 million US dollars.
And the scale of this demographic is just staggering.
It really is. The report notes that the IMILI bracket has more than quadrupled since the year 2000.
Quadrupled. Let that sink in.
We are currently looking at roughly 52 million people globally who fit into this specific category. Collectively, this group controls $107 trillion in wealth.
Which means they are rapidly approaching the $119 trillion held by everyone in the world with over $5 million.
The gap is closing fast, and the growth curve is only accelerating. Like in 2024 alone, the global economy minted over 680,000 new US dollar millionaires.
If you break that down, it's roughly 1,800 new millionaires created every single day.
Wow. And the geographic distribution of that growth is equally telling, right?
Oh, definitely. While the U.S. and China added massive absolute numbers, the proportional growth was highest in specific strategic nodes.
Look where.
Well, Turkey saw an 8% increase in its millionaire population, and the United Arab Emirates saw a 5.8% increase.
So we're seeing a rapid accumulation of wealth in regions that essentially act as geographic and financial bridges between the East and the West.
Exactly. They are positioning themselves perfectly.
Okay, I have to challenge the actual purchasing power of this demographic, though.
Sure, go ahead.
We use the term everyday millionaire. But let's be real, after the aggressive inflation cycles of the 2020s, $1 million simply does not buy what it did in the year 2000.
That's a very fair point. Inflation has changed the math.
Right. In prime global cities like London, New York, or Paris, $1 million barely covers the purchase price of a standard two-bedroom apartment, let alone a luxury asset.
Yeah, you're definitely not buying a mansion in Mayfair for $1 million.
So is a person sitting on exactly $1 million really a primary driver of global luxury real estate and offshore wealth management? Or are they just, a professional who managed to pay off their mortgage and max out a retirement account?
You're hitting on a crucial nuance within that 52 million person cohort. The $1 million mark is really merely the entry threshold.
Okay, so it scales up from there.
Exactly. You are correct that an individual with a net worth of $1 million isn't seeking complex offshore tax structuring. They aren't buying prime international villas.
They're probably just trying to figure out how to retire comfortably without running out of money.
Overwhelmingly, yes. They are focused on domestic retirement security. However, as you move toward the $3, $4, and $5 million marks within that exact same IMILI demographic, the behavioral mechanics change entirely.
How so? What happens at $4 million?
Well, at $4 million, a family typically has their primary residence fully paid off. Their domestic retirement accounts are fully funded, and they now possess surplus liquid capital.
Ah, so that's the tipping point, the surplus cash.
Right. They are no longer looking for aggressive venture returns to build wealth. They are looking for geographic diversification, second passports, and tax-advantaged jurisdictions to preserve what they have already built.
And because there are so many of them, their sheer numbers dictate the market.
Absolutely. There are simply not enough billionaires in the world to sustain the sheer volume of luxury real estate being developed globally.
So the developers are basically building for the upper end of those 52 million everyday millionaires.
Exactly. And this brings us to another massive variable. The UBS report highlights the great wealth transfer.
Oh, this part is huge. We are looking at $83 trillion scheduled to change hands over the next 2 decades as older generations pass away.
It's the largest transfer of wealth in human history. But the most disruptive element of that $83 trillion transfer is the structural routing of the capital.
Because everyone just assumes it goes straight down to the kids, right?
Yeah, it's widely assumed this money simply flows vertically down to millennials and Generation Z. However, the data highlights something completely different.
Right. The roughly $9 trillion of this wealth will actually transfer intergenerationally. horizontally between spouses.
Yes. Given standard actuarial tables and life expectancies, this means a massive concentration of wealth is about to be inherited by women.
Okay, so how does that demographic shift fundamentally alter capital allocation?
It's a great question.
Like, if a woman inherits a $5 million portfolio from her spouse, how does her deployment of that capital differ mechanically from how it was previously managed?
Extensive behavioral finance research indicates a marked shift in risk profiles and priorities when this happens.
They get more conservative.
Exactly. When wealth transfers to female spouses, we consistently see a reallocation away from highly aggressive, speculative asset classes like early-stage private equity or highly leveraged equities
And where does it go instead?
toward capital preservation, yield stability, and tangible assets. There is a pronounced emphasis on legacy planning, sustainable environmental factors, and secure real estate in highly stable jurisdictions.
So the demand curve basically shifts from how fast can we double this to how securely can we protect this for the next generation.
That is the exact psychological shift. Capital preservation becomes everything.
Okay, so let's zoom out. We have an expanding army of 52 million everyday millionaires. They're increasingly focused on capital preservation, and they are sitting on $107 trillion.
It's a tidal wave of money looking for a safe home.
Right, and if you are a sovereign government watching this macroeconomic wave build, you do not passively wait for that capital to arrive. You engineer a system to actively capture it.
You build a net to catch the fish.
Exactly. And in the early 2020s, no jurisdiction captured this exact demographic more aggressively or intelligently than Dubai.
Dubai's strategy was frankly a masterclass in eliminating bureaucratic friction.
They saw the Emilis coming and rolled out the red carpet.
They recognized that wealthy families face an enormous burden of compliance, taxation, and administrative drag when they try to move capital through Western financial institutions.
So Dubai looked at that demographic and basically systematically dismantled every single barrier to entry.
Right. The regulatory updates from the Dubai International Financial Center, the BIFC, from January 2023, map out exactly how they built this frictionless environment.
They launched the Family Wealth Center and enacted these new family arrangements regulations.
And the foundational move there was entirely repealing the old single-family office regulations.
What did they replace it with?
They replaced it with a framework that explicitly removed the requirement for a family office to register as a designated non-financial business or profession with the Dubai Financial Services Authority.
Okay, a DNFBP. I know we talked about this, but we really have to break down the sheer mechanical pain of the DNFBP classification to understand why removing it was so revolutionary.
It really was a game changer.
In legacy markets like London or Frankfurt, if an everyday millionaire wants to set up a private family trust or a holding company to manage their $3 million of surplus capital, the regulatory apparatus basically treats them like a commercial bank.
Yes, they are subjected to intense anti-money laundering audits, rigorous know your customer compliance protocols, mandatory external financial reporting. It's endless.
And they're literally required to hire dedicated compliance officers.
Right. And the legal and accounting fees alone can erode a massive percentage of their annual yield.
It is effectively a regulatory tax on simply existing.
Precisely. It's punishing. But Dubai recognized that a family managing its own privately earned wealth does not pose the same systemic risk as a hedge fund taking outside capital.
So by stripping away the DNFBP classification, Dubai allowed these families to establish corporate structures and manage their wealth without that crippling administrative overhead.
Exactly. Furthermore, they introduce a highly secure private register for family entities.
Which perfectly solves the privacy issue.
Because privacy is huge for this demographic.
Oh, absolutely. In many European jurisdictions, public beneficial ownership registries mean anyone with an internet connection can look up exactly who owns which asset.
Right. And for the wealthy, privacy is not just a preference, it is a profound security requirement.
So by combining absolute privacy, zero income tax, long-term golden visas linked to property investment, and zero bureaucratic friction, Dubai basically engineered a bespoke ecosystem.
They built a financial fortress tailored perfectly for the rising Emily class.
I look at Dubai's strategy like buying a printer.
Wait, a printer? How so?
Yeah, hear me out. If you want to capture a massive customer base, you practically give the printer away for free.
Oh, I see where you're going with this.
Right. The printer, in this case, is the 0% tax rate and the totally frictionless legal setup. It draws everyone in.
The cost of entry is basically zero.
Exactly. We will talk about the cost of the proprietary ink cartridges, which are the running costs, in a moment. But initially, the strategy worked flawlessly.
It worked incredibly well. The real estate data from Savills in August 2025 completely validates the sheer effectiveness of that regulatory strategy.
The Savills data is actually extraordinary. By mid-2025, Dubai was ranked among the top 3 global prime residential markets for capital value growth.
They recorded an increase of more than 5% in just the first half of 2025 alone.
And the rental yields were astronomical. They were up 13.3% year over year.
Which is unheard of in mature markets.
Right. When you compare a 13.3% yield in Dubai to the standard 3% or 4% yield you might fight for in a prime London borough, the mathematical incentive to migrate your capital is just undeniable.
And Andrew Cummings from Savills pointed out that this growth was occurring despite wider macroeconomic uncertainty in other regions.
So Dubai was acting as a real anchor.
Exactly. Dubai's prime market was demonstrating intense stability. It was bolstered by high global connectivity, explicitly investor-friendly policies, and rapid population growth.
The capital arrived exactly as the DIFC designed it to. They basically built a perfect, temperature-controlled biodome for global wealth.
A biodome is a great way to describe it.
But a biodome is only as secure as the glass it is built from. And here's where we transition into the stark reality of early 2026.
The moment the glass cracked.
Exactly. What happens to a carefully engineered financial haven when its physical geography becomes a liability?
Now, this requires a highly objective analysis of the geopolitical events that occurred. We really need to strictly focus on their immediate mechanical impact on capital markets.
Right, we must separate the political narratives from the financial data.
Absolutely.
For you listening, it is vital to understand we are not taking a stance on the geopolitical conflicts themselves. Our strict mandate here is to track how these documented events act as catalysts for the movement of global wealth.
Just following the money.
Precisely. According to the updated Ep.002 market report from March 2026, the perceived security of the Dubai market was violently compromised.
Yeah, the timeline here is critical.
In late February 2026, following U.S. and Israeli military strikes on Iran, Iranian forces launched retaliatory drone and missile attacks targeting the United Arab Emirates.
And the critical variable for real estate is not just the occurrence of the attack, it's the specific geography of the debris field.
Right, because when air defenses intercept a drone, the kinetic energy and physical mass still have to land somewhere. Gravity still works.
Exactly. The MP-Dunn report details that Iranian drone debris struck near Dubai International Airport, the Burj Al Arab, and the Palm Jumeirah.
These are not remote desert outposts. These are the highly populated, intensely symbolic epicenters of Dubai's luxury brand.
And the strikes forced temporary closures of the airport,
which disrupts international travel and basically severs the physical connectivity that Savills had cited as a core market strength.
The psychological impact of debris falling on the Palm Jumeirah simply cannot be overstated.
Because it shatters the illusion.
Completely. A safe haven is not merely a legal designation written in a DIFC tax code. It is a fragile psychological construct built on the investor's perception of absolute physical security.
And when that perception is punctured, the risk premium recalculates instantly.
Instantly. Capital panics.
The Goldman Sachs data cited in the report quantifies that panic perfectly. Analysts estimated that real estate transaction volumes in Dubai fell by a staggering 37% year over year.
And that was in just the first 12 days of March 2026.
Yeah. Looking month over month, the market contracted by 49%.
We are talking about half the transaction volume vanishing in less than 2 weeks.
This was a steeper and faster contraction than the market experienced during the historic floods of 2024. Sellers were immediately forced to offer discounts ranging from 12% to 15% just to maintain liquidity.
But, and this is crucial, we must analyze the structural integrity of the market prior to the strikes.
Okay, so you're saying the market was already weak?
Yes. The geopolitical shock was the catalyst, but it struck a market that was already fundamentally over-leveraged. The MP-Dunn report incorporates vital context here. Prior to the conflict, the UBS Global Real Estate Bubble Index had already ranked Dubai as having the 5th highest property bubble risk among 21 major global cities.
Wait, why was the bubble risk so high if demand from that Emily demographic was supposedly so strong?
It all comes down to the supply pipeline. Fitch Ratings had already issued a warning projecting a potential 15% price correction for 2025 and 2026.
Because they were just building too much.
Exactly. The sheer volume of new luxury stock being constructed to capture the incoming wealth was outpacing even the aggressive demand curves.
So the market was saturated before the drones even launched.
The market was totally saturated. The drone strikes did not cause a 15% drop in a vacuum. They effectively popped a speculative balloon that was already stretched to its absolute physical limit.
I have to look at this from the perspective of an opportunistic investor, though.
Oh, play devil's advocate.
Financial history proves that markets wildly overreact to acute geopolitical shocks. Look at the London real estate market after the 77 transit bombings, or the New York market after 9/11.
True, the markets froze.
They froze, capital panicked, but the underlying institutional strength of those cities eventually pulled the valuations back up.
Yes, eventually.
So for an investor with a high-risk tolerance, aren't these 15% discounts Dubai exactly the buying opportunity you wait for? As the DAR Global CEO noted in the report, things start quickly and end quickly in the Middle East region.
It is a valid theoretical argument, but it misinterprets the specific demographic we are tracking.
How so?
Because you are applying the logic of a distressed asset hedge fund to a 55-year-old everyday millionaire looking for a retirement home.
All right.
The Emily demographic is overwhelmingly driven by capital preservation, not high-risk arbitrage.
They aren't trying to time the market, they're trying to hide from risk.
Exactly. As Joe Eccles, a buying agent quoted in the MP Dunn report, stated events like these serve as a stark reminder that physical stability in the Middle East cannot be assumed as a baseline.
Right. If a family from Northern Europe is debating tying up 3 million euros of their net worth in a 10-year holding pattern, a 15% discount on the purchase price does not remotely compensate for the risk of raising children in an active interception zone.
They do not want a discount on the risk. They require the total absence of the risk.
That makes total sense.
There.
And that structural demand for the total absence of risk triggers the flight to safety.
The capital pulls up its anchor in the Middle East and immediately seeks a new harbor.
Which brings us to the ultimate utility of the MP Dunn report, the 5 million euro question.
Yes. Where does the money go?
Exactly. When wealth flees a compromised haven, where does it land and what exactly does it buy? We are going to conduct a mechanical comparison of what 5 million euros secures in Dubai, the legacy markets of London and Nice, and the rapidly ascending safe haven of Marbella, Spain.
And this comparative analysis reveals the complex, multivariable calculus a high net worth buyer utilizes.
It's never just about the sticker price, is it?
Never. It is an equation balancing physical space, upfront taxation, ongoing operational friction, and environmental security.
Well, let us isolate the physical space variable first.
Mm.
If a buyer deploys 5 million euros, what is the literal footprint they are acquiring?
According to the MP Dunn data, in Dubai prior to the recent pricing corrections and currently in Marbella, a 5 million euro deployment secures massive scale.
How massive?
You are acquiring a contemporary detached villa ranging from 520 to 600 square meters of built space.
That translates to roughly 5,500 to 6,500 square feet. That is true estate-level living.
Yes. You are talking about 6 ensuite bedrooms, expansive private grounds, infinity pools, integrated smart home technology, and private wellness facilities.
It's architecture designed entirely around seamless indoor-outdoor living.
Now take that exact same 5 million euros and transplant it into the prime districts of London, places like Mayfair, Knightsbridge, or Kensington.
Okay, what do I get there?
Your footprint shrinks violently. You are acquiring approximately 220 square meters.
Wow. You are losing well over half your space.
Yeah. You are trading a sprawling villa for a 3 or 4 bedroom mansion block flat, or maybe a narrow mews house.
Often with zero private outdoor space beyond a small balcony.
Exactly. You are paying an enormous premium purely for the institutional permanence and the prestige of the postcode.
What if I move that capital to the French Riviera, places like Nice, Cannes, or Saint-Jean-Cap-Ferrat? What does 5 million euros secure there?
Roughly 200 to 350 square meters. You gain heritage charm and Mediterranean views, but you are typically buying older, legacy housing stock situated on highly constrained, steeply pitched plots.
So no sprawling modern lawns.
Unlikely. To acquire a modern 600 square meter villa on the Riviera with the amenities of a Marbella or Dubai property, your capital requirement easily exceeds 10 to 12 million euros.
So on a pure price per square meter basis, Dubai and Marbella offer vastly superior physical assets.
Without a doubt.
But as we established earlier, the initial purchase price is just the entry fee. The true cost of a property is determined by the long-term tax structure and the ongoing operational friction.
The hidden costs of wealth.
Exactly. Let us examine the tax mechanics, starting with London.
London presents a fascinating contradiction. It does not levy a specific annual wealth tax, which historically made it highly attractive for capital preservation.
But I'm guessing there's a catch.
A big one. It penalizes the asset heavily in other ways. First, you face a severe transactional friction at the point of purchase.
The entry fee.
Right. If you are a non-resident purchasing a second home, you are hit with a 15% stamp duty land tax.
Wait, 15%. So on a €5 million property, you are surrendering €750,000 directly to the government just to receive the keys.
Just to open the door. Furthermore, if you attempt to generate yield by renting the property, the UK imposes a punishing income tax on those earnings.
Which can scale up to 47% for high earners, right?
Exactly. The capital inefficiency there is massive. You pay to enter, and you are heavily taxed on the yield.
Okay, so what is the mechanical structure of the French tax burden then?
France deploys the most aggressive, multi-layered tax drag of the four markets.
More than London.
Oh, yes. Beyond standard property taxes and specific levies on second homes, they enforce the IFI, the Impôt sur la fortune immobilière.
Right. This is a dedicated wealth tax applied specifically to real estate assets. Let us break down exactly how the IFI functions, because it dictates buyer behavior in really strange ways.
It definitely distorts the market.
It applies to properties valued over €1.3 million, correct?
Correct. But the critical mechanic is that it applies to the net debt-free value of the property.
Net value. Okay.
The MP report calculates that for a fully equity-owned €5 million property, the French wealth tax alone strips roughly €41,000 of capital from the owner every single year.
That is wild, and this creates a bizarre incentive structure, doesn't it?
Very bizarre.
Because the tax only hits the equity portion, incredibly wealthy buyers who possess €5 million in liquid cash will intentionally take out expensive mortgages they do not actually need.
Exactly. They take on debt purely to artificially lower the net asset value of the property on paper just to dodge the IFI.
It forces capital into inefficient, highly bureaucratic debt structures simply to avoid annual wealth erosion.
And when you couple that with high French income tax on rentals and aggressive social charges, the ongoing friction is immense.
Which brings us back to Dubai's primary value proposition. Their tax structure is designed to completely eliminate that friction.
Zero income tax on yields, zero capital gains tax upon sale, zero annual wealth tax.
The entry friction is limited to a single 4% transfer fee, plus a 5% municipal housing fee pegged to the property's rental value, which equates to roughly €12,500 annually.
It looks perfect on a spreadsheet.
This is where we must apply the printer and ink analogy from earlier. The Dubai tax structure is the free printer.
Yes, the government practically gives you the legal framework and the tax exemptions for free to get you into the ecosystem.
But the physical reality of maintaining a 600-square-meter villa in a desert environment is the proprietary ink cartridge that constantly drains your capital.
The MP data is explicit on this point. Dubai possesses the highest operational running costs of all four markets evaluated.
I mean, think about the sheer energy required for year-round industrial-scale air conditioning.
And massive water consumption for landscaping in an arid climate.
Plus the enormous community fees required to maintain the pristine artificial infrastructure of developments like Palm Jumeirah. They are staggering.
The report estimates the annual running costs for a prestigious Dubai villa range between €38,500 and €65,000.
So the tax savings are entirely cannibalized by the utility and maintenance bills. You aren't paying the government. You're paying the utility companies and the homeowners association just to fight the desert climate.
Exactly. The capital drain exists. It is just reclassified from a tax to an operational expense.
And this mechanical reality is what makes Marbella so structurally appealing to the Emili demographic fleeing the Middle East.
It really hits the sweet spot.
Let us unpack the Marbella equation. The initial purchase friction is moderate, typically around 10% to 12%, covering the property transfer tax, notary, and legal fees.
But the true advantage lies in the ongoing operational costs.
Because of the environment.
Exactly. The Mediterranean climate drastically reduces the energy burden. You do not require year-round, intense air conditioning.
And the community fees are substantially lower because the local infrastructure is not artificially reclaimed from the sea or built on a desert floor.
Right. For a high-end property in Marbella, the annual running costs are estimated between 11,500 and 17,000 euros.
That's a fraction of Dubai's costs. But Spain does impose a wealth tax, which initially sounds like the French IFI. We need to distinguish the mechanics of the Spanish solidarity tax.
It is different. Spain introduced a national solidarity tax on net wealth exceeding 3 million euros.
Okay, so the threshold is much higher than France.
Yes. For a 5 million euro property, a 1.7% rate is applied strictly to the 2 million euros sitting above the threshold.
Right, because the first 3 million is exempt. So that resulted in an annual liability of roughly 22,000 euros.
Which is roughly half of the French IFI burden.
So when you build the final spreadsheet and combine the annual tax liabilities with the actual physical running costs, Marbella emerges as significantly more capital efficient than London or France.
And surprisingly competitive with Dubai once you factor in the massive desert utility bills.
It's incredible how the math flips when you include operations. But the final variable in the MP Dunn report transcends financial metrics entirely.
Yeah, this is where the conversation shifts.
It introduces environmental and physical security as core luxury assets.
The air quality data is a perfect proxy for this.
Right. The report notes Marbella enjoys a PM2.5 air quality reading of 5 to 9. That falls squarely within the World Health Organization's safe guidelines.
And what's the reading for Dubai?
Dubai averages a reading of 29. It's driven by intense urban development, vehicle emissions, and natural desert dust.
When the Emili demographic is choosing where to raise their children or spend their retirement, chronic exposure to particulate matter becomes a severe liability.
You combine that superior environmental baseline with highly affordable world-class private health care in Spain, plus a deeply established international school network.
And, most critically, an environment firmly embedded within the legal and physical security apparatus of the European Union.
It is entirely insulated from the acute geopolitical crosshairs that are currently defining the Middle East.
So the flight to safety is entirely rational.
London demands you sacrifice space and yield for prestige.
Nice demands you sacrifice modern amenities and pay punitive wealth taxes for historical charm.
Dubai offered a frictionless financial utopia, but exposed you to massive climate costs and the sudden violent reality of regional conflict.
Marbella is currently capturing this massive migration of wealth because it represents the optimal synthesis.
It really does. It provides the massive physical space and modern indoor-outdoor lifestyle of Dubai, but it's coupled with the profound institutional stability and physical safety of legacy European markets.
While engineering a combined tax and operational cost structure that does not actively erode the asset.
That is why the data shows 63% of prime buyers in Marbella are now international. They are the everyday millionaires, moving their capital out of the blast radius.
We are observing capital seeking an equilibrium between financial efficiency and physical reality. The illusion that a 0% tax rate can compensate for geopolitical instability has been broken.
Completely shattered. Well, as we conclude this analysis, we've basically traced the entire life cycle of this capital migration.
We covered a lot of ground today.
We really did. We examined the UBS data to understand how global wealth expanded, specifically analyzing how the median wealth in the middle tiers surged ahead.
We identified the 52 million everyday millionaires who control $107 trillion.
And the impending intragenerational wealth transfer that will place unprecedented capital in the hands of female investors focused on stability.
Then we dissected the precise regulatory mechanisms Dubai used to capture that demographic by eliminating bureaucratic friction.
Only to witness how the physical reality of a drone strike shattered the psychological security of that engineered haven.
Finally, we tracked that panicked capital mathematically, proving why the structural, environmental, and financial efficiencies of southern Spain are making it the premier destination for the flight to safety.
But I want to leave you, the listener, with a final mechanism to ponder as you observe the global markets going forward.
It's a big question.
Historically, the definition of a safe haven was entirely dictated by financial metrics. It was defined by the opacity of a Swiss bank vault, the lack of capital gains tax in a Caribbean registry, or the DNFBP exemptions in a Middle Eastern financial center.
It was essentially a legal fiction written on paper.
Exactly. But as we move deeper into an era defined by $83 trillion changing hands amidst unpredictable climate shifts and sudden localized military conflicts, The foundational rules of wealth preservation are mutating.
The rules of the game are fundamentally changing.
So will the ultimate luxury of the future shift entirely away from financial engineering and toward fundamental physical reality?
Yeah, is the question.
I mean, in 20 years, will a 0% tax rate matter if the property requires $100,000 a year in energy costs just to keep the interior habitable?
Probably not.
Will capital flow toward jurisdictions that offer the highest yield, or simply toward land masses that offer the cleanest air, the most secure borders, and elevation above rising sea levels?
The physical environment is becoming the ultimate asset.
When we look back at the global wealth map from the year 2050, the true fortresses of the ultra-wealthy may not be built on tax codes but on bedrock. Think about how that reprices every piece of real estate on Earth. Thanks for taking the deep dive with us.